Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
David, welcome to the show. How are you?
Very good. Thanks so much for having me, Sarah. How are you?
Good. I'm excited to have you. I think, a few years, many years back, you came on and you came on as a mortgage broker at some point. You also came on as my prior bookkeeper as well, I believe, which is what you were doing back in the day. So, for those of you that or those listeners that may not have heard of you, you're the David G that everybody speaks to, but maybe just give us a little bit of a background on who you are.
Yeah, absolutely. So my name is David Giustizia. Myself and my partner Sue run two mortgage teams. So we have our Vision Mortgage Group, which is our residential team, helping everything from first-time buyers right up to larger investors work with residential financing and help kind of create their vision, understand where they want to take the portfolio, and figure out the execution strategy that'll allow them to do it. And then more recently, over the last bit over a year now, we launched Vision Capital Partners, and that is our commercial division, predominantly focused on multifamily rehabilitation. So taking older, underperforming buildings and using TLC, turning them around, stabilizing the incomes and refinancing, a little bit of land development this year. So working on, property and ground up builds, probably our bread and butter. We do dabble in office and industrial and a few other asset classes here and there, but really multifamily is kind of our optimization space. And again, just same strategy, helping investors kind of set that vision, understand what's attainable, understand kind of the highest and best use and how they can approach a property and a project to really get the most out of it.
Awesome. So you dabble in everything, and it sounds like you're really focused on some of the bigger ticket items, right? Multifamily onwards. So there's obviously, a lot of investors, I think right now that are kind of just sitting on the sidelines, trying to figure out what the next move is. But what are you seeing that works well? Like you're probably still getting a few opportunities come your way. Like what deals, and maybe strategies seem to be working in 2023?
Yeah, I mean, great question. We've actually been so on the investor side, I'm a fairly passionate investor myself as well. We've actually been super active through the tail end of 22 and 23. In terms of strategies, we've divested a pretty significant portion of our, I'll say, smaller residential holdings, so single family, duplex, triplex. The numbers on those are they're getting kind of strange with where rates have gone. Some of the triplexes and fourplexes do still work, but not in the way that they used to at the current value. And especially, for those that are looking to strip equity or gain additional leverage, as soon as you do that, you're paying the new rates, you're at 75-80% of the value. That cash flow is really getting squeezed, if not negative, and turned our attention mostly to buildings. And so with buildings, our focus is really on rehabilitation projects. It's on stuff that is usually older, 60s, 70s, 80s builds, stuff that just see a lot of like absentee landlords, people that just kind of do the absolute bare minimum, haven't put any effort into the building, just kind of keep it as a going concern. And those buildings are typically really ripe for opportunity, gaining some energy efficiency awards and points through the MLI Select Program, so we can refinance really effectively. And we've seen a lot of lift in those categories. We had a project that we bought and sold during 2022, and we actually bought it at the peak, sold it at what now seems to have probably been the bottom around November, December, and still did quite well on it. Our newest project that we closed in December has been going really great. So it's really those economies of scale, like getting into that 8, 10, 12 plus unit. It is a little more capital intensive, but we found the ability to get your capital back a lot stronger. The ROI is a lot stronger. The whole project they tend to make a lot more sense now. There's some tremendous deals out there.
Now, when you're saying you bought, like we bought, is that you included or are you helping an investor, or are you also like these are part of your projects?
So both. I mean, I typically do like 2 to 3 a year. We usually keep it. I mean, the mortgage side and our mortgage operation keeps me fairly busy, so I can't be as active as yourself and some others. But I do still really like, doing those projects. So we do try and do about like 2 to 3 a year. I got, some we do solo, some we do with JV partners. I got just a handful of small partners that we work with and do work together on. But also for clients, like same kind of idea. I mean, one of the nice parts about being in the mortgage space and spending a lot of time with investors on both the residential and commercial side is we just get to see so much, right? I get to look at other people's deals, look at other people's rent rolls, look at the cap rates that they're acquiring at, look at the finished products, how long it's taking the renovation, how much they're costing, are they coming in over budget, under budget? Like it really, you get a really strong sense of what's happening through the industry. And I think one of the big themes for the tail end of 22 and early 23 is that there's a lot of really good quality buildings out there that are trading at prices that would have just been like unheard of 12, 18 months ago.
Hmm.
And so there's really some great deals to be had for people who are looking carefully.
Nice. So are you what about you as an investor? Like, are you currently still actively looking? Are you pausing? Because, are you just looking at, stuff that you can exit with the MLI Select program? I know you like that one quite a bit. What's your
Yeah. So our most recent one we closed in December. So we're kind of just at the entry stages of that project. That won't actually be an MLI exit. We're still looking. I actually had another offer going today on something like way out of left field, not multifamily. I won't share too much because there's not very many of them on the market, but
Mhm.
something super weird. We'll see how that goes. But yeah, still really aggressively looking right now. I think this drop in rate, going back a couple, like a month and a bit ago now, like with the failures of SVB and a couple of the other banks, Credit Suisse takeover, like the bond yields have just really dropped significantly. And that's largely played into residential rates, but it plays into commercial rates even more. And so, stabilized financing, even project financing, we've been seeing better opportunities, better pricing. And still really aggressively out there hunting deals and finding opportunity. We've removed most of the weight we're putting on MLI right now.
Mhm.
And not going to talk about it too much. I'm sure you've had lots of MLI discussions on this podcast over the past 12 months, but our anticipation is that program isn't necessarily going to be around these current form very much longer. And so for our models and our performance, we're kind of running it under the average, like standard CMHC program. If push comes to shove at the end and we're actually able to use the MLI product, phenomenal. That'll be icing on the cake. But for us, we need to make sure at this point that any kind of projects that we're getting into at this point they still work if that doesn't exist by the time we're ready to refi.
I mean, it's a fairly new program. I love that program. Let's hope that it's still available. But I guess you still have to run your numbers as a worst case scenario if you just exit with CMHC regularly.
Yeah, there's been a lot of changes to CMHC in the last 12 months. There's been a lot of discussions. I think there's aspects of the program and like any new kind of government policy like this, we typically get into like a little bit of a review period, right? They launch something, they kind of have an intention of how it's going to play out. About a year in, they're going to look at it and recognize that maybe there's certain aspects of it that aren't playing out the way it was anticipated. And I think for us, in the discussions we've been having with our lenders, with our CMHC correspondents, like the biggest piece that we're seeing here is this like retrofit energy efficiency thing. Not really doing, I don't want to use the word being abused, but it's being very heavily relied upon. And there's a lot of MLI product that's being issued in the marketplace that has no aspect of affordability, which I think was the kind of most pressing component of the program that CMHC was really after. And so this idea that you can, retrofit a building, bring the energy efficiency 40% above the baseline, which for some of these old buildings is like a really low baseline. So with some of the different pool allocations and funding allocations, like we're already seeing a rates differential. So lenders that'll have a much better rate for MLI that contains an affordability metric than MLI that doesn't. And I think at some point we will see, I don't know, I don't think it's likely the whole thing's going to be abolished, but I think we'll likely see some changes to it. And CMHC trying to pull it in a little bit closer to what they had in mind when they launched it.
I mean, I guess the issue is, in some markets such as Ontario, with the fact that you've got to keep some of these low rents low for, was it 10 years? Um,
Years, yeah.
is likely not the best course for many investors, because the other issue, even if you're like, hey, I want to like, take a few units based on what, if you're a brand new building or you're retro or whatnot. And then there's that a threshold that you have to be below, right? So maybe you can go through that, but you also have to keep it low for a certain amount of time. And the other issue that I have with this, and this is sometimes, when they come up with these ideas and they try to implement them, like the debt coverage ratio may or may not even work. So like if you're trying to get these points so that you can exit, the best option using the low rent option. And I shouldn't call it low rent, but it is that's what it is.
Affordability metrics, yeah.
Affordability, exactly. It's not always in our best interest because you may not be able to exit based on the NOI. So maybe just go into that piece a little bit. I know that, like you said, that's what CMHC originally wanted to do, is create more affordable housing. But as investors and business owners and in certain markets, it doesn't always make sense to go that route.
Yeah. So I guess the way that I can best describe the program is it's really broken down into two tranches of 3 segments. So the scoring system is based on 3 metrics. It's based on energy efficiency, it's based on affordability, and it's based on accessibility. For a lot of buildings, accessibility is top on a retrofit. Like if it wasn't already designed to be accessible, doing that conversion is largely like not an option in a lot of cases. There are some select cases where it is, but
and it's very costly. And I think it's just like what, a 30-point max that you could do, and then the threshold between to get like 50 points as an example, and like 30 more is not that big of a difference.
It's not something we seem to focus on. Right. Yeah, I think for the new builds, that's making more sense because the incremental cost on that is not what it is on the retrofits. Right. So if you're designing the building from scratch, it's depending on, again, the original design, it's not that big of a deal, but I've actually seen no utilization of it in the retrofit. Energy efficiency, which is like 30 points for 15% reduction, 50 points for 25, and 100 points for 40%. So that means that with the 3 MLI tiers and 100 points gets to the top tier, somebody could arguably get to the top tier of the MLI program just by doing a 40% energy reduction, nothing else. And that's what we're seeing a lot of, if I'm being honest.
That's what we're trying to do as well.
That's what everybody's trying to do, right? Like, exactly. Yeah. So I think like what I'm seeing with that is, although it is great, it is a lot of the programs and a lot of the rehabs that we've seen done are going to a much more energy efficient approach than they would have if this program didn't exist, right? So we're seeing movement towards like heat pumps. We're seeing movement towards high efficiency. We're seeing people, beef up insulation, low flow on shower water utilization. Like there's a lot of really good things that's come from this program in terms of these people spending another 20-30% CapEx on these retrofit projects. At the same time, is it worth it for CMHC to knock 83% off their insurance premium to have people do that? Probably not. So, nothing's official has been released yet. I think, I'll start by being pretty clear on that. But one of the things that I could see potentially happening is that they attribute less points in those energy efficiency reductions. I could see them clawing back and saying, look, just because you do 40% energy efficiency doesn't mean we're going to give you the whole 100 points. If you want 100 points, it might be a combo of that plus affordability or that plus something else. So I think that's been the piece of the program that's been, I guess I'll say, abused. The other one is the affordable rents. And the thing that's kind of odd, I'll say, is on the affordable rents, in they kind of classed into 2 tiers. So there's one segment of metrics if you're retrofitting. There's a separate segment if you're new build. And the new build segment is far more generous, right? So on the retrofit, if you want 100 points, you have to keep 80% of your units as affordable. That's a huge hit to the NOI. Like that's not attainable for where most people have their leverage to be able to do that and put a 10-year commitment on that.
And that 10-year commitment is really where it's also hard to justify as well.
Yeah, it is. But if you go down to the new development for that same 100 points, you're only looking at 25% of your units, right? For 70 points, you're only looking at 15% of your units. And for 50 points, you're only at 10% of your units. So on a new development, you did like 10% of your units affordable and a 25% better than building code energy efficiency, you'd get your whole 100 points. And that's a lot more, a lot easier to stomach and a lot easier to still make financing work. And I think that's part of the problem we've seen on the affordability side is the program's really reasonable when it comes to how they treat new builds. When it comes to how they treat existing buildings, it's a lot less juicy. And the energy efficiency is actually in reverse. Because on energy efficiency on a new build, the reduction is against building code. On a retrofit, it's against the existing structure. And so a lot of these structures that are 40, 50, 60 years old are actually in much worse shape than standard building code, right? So what it takes to get them, 40% more energy efficient than where they are today is in many cases, it seems to the extent where you can even have to do anything with HVAC to accomplish that, which is like kind of mind blowing.
Yeah. And then the affordability too, just to go back. So like if you're doing something that's fairly new, let's just say you're doing the 15 or 25%, that could be your smallest of the small bachelor units, right? And then so like how do they measure the efficiency? It's a percentage below the average rent by the area. Is that how it was? Or you might know better.
So it's 30% of median rent for income is what's deemed affordable. And again, this is really interesting because it affects differently in different markets. Right. So if you look at somewhere like Hamilton or Toronto, those rents are drastically below market. Right. So where you have to cap those rents to fit that affordability metric is, in many cases, less than half of market rents. If you go to some other areas, Northern Ontario, some areas out west, those are actually like on par with market, sometimes above market. Right. And so in some of those areas, it actually makes a ton of sense to do it because if somebody said, okay, well, we're going to cap your rents at 120% of your market rents, that's not much of a concession.
Right.
That's nothing. But it's really in these kind of high density, high rent areas where that really creates a big challenge. And so, where I think they're targeting on the existing buildings is really these, I'll almost say like these absentee landlords, right? Like these, maybe absentee is the wrong word, but landlords that just don't have an interest in like optimizing their asset. You have these people that are sitting on apartment buildings. One of the ones we bought traded in, it was 11 units. It traded for $300,000 back in the early 2000s, right? People don't have a mortgage, or maybe they have like a couple $100,000. They're just sitting on an asset. Like the rents are all low. They don't really care about moving them. They're happy with the tenants they have. This is where you can go to these older existing owners and say, look, like, there's an opportunity here to extend your amortization, increasing cash flow, give you, we're seeing sub 4 rates on CMHC funding right now. Get back to some of these, great boring products. And all you have to do is commit that you're going to do what you've been doing for the last 20 years for the next 10. And so I think that's where that program is being leveraged a little bit. But for investors that are looking for that rehabilitation, who need the higher levels of leverage or are striving for that, 75, 80, 85, 90, 95% loan to value, as soon as you start making concessions on affordability, your net operating income just is not going to be where it needs to be to give you the level of takeout that you need. And I think that's probably the biggest challenge for, I'll call it like more retail investors, right? So like stepping away from, let's say, the REITs or the funds or the big GPLPs that are putting 30, 40, 50% down, going into like the smaller investors who want to try and do this with, 25, 30% capital. It's been really challenging for them to make use of that program. So what I'd love to see, what I think would make sense from, CMHC standpoint, they're trying to, look, I really don't want them to change the energy efficiency thing. It's awesome. And if we can keep that as is, I think everybody would be happy. But if they are really looking to do that, I'd love to see a world where if they do kind of claw back on the points that they're giving there, I'd love to see them be a little bit more lenient on their affordability metrics for retrofit and existing properties. Because I think they would get a lot more uptake if they could pull some of those numbers down a little bit. And it would be much more attractive, when we're talking about doing 10 or 20% of your units instead of 80% of your units.
Yeah, no, I think like they need to have these discussions with mortgage brokers, with real estate investors and people that are in the industry, because they're creating these programs, but they're not realizing that like there are going to be parts that we are not going to want to do because it's set up for us to not be able to pull out 95% loan to value if we even get the points, as an example, because the NOI is not high enough. So, and again, and the 10-year thing is also an issue, but and like, and I think they check, right? They like, you need to give them an update or something every single year. So it's not like you could just, or maybe,
Yeah. All the, I mean, if you don't, you go into detail, like all of the CMHC insured lenders, you have annual reporting requirements, all of that. But yeah, and you actually have to freeze on the 10-year thing, like it's for the particular unit. So, I've had questions come to me like, hey, well, I have this whole building that's like under rented. If we just arbitrarily pick, like, let's say we're trying to go for the 60% threshold. So we pick these 60% of our units. Let's say we have 10 units, we pick these 6 and say, okay, these are going to be the affordable ones. If you have somebody in those units that naturally turn over, you can't just treat one of your other units that's affordable anyway as the affordable unit. Like it's tied to the specific unit.
right.
So it is like fairly inflexible in that way.
And
It's not just about keeping the overall affordability on the building.
do they have a say on like who you rent to? Like, could it be your friends, friends and
They don't.
family?
They don't. No, they don't
Yeah.
have a say on who you rent to, which is great. And I mean, if you want to buy a building and create like a party house with all your friends, it's not a bad choice. Might make living in like some of these areas a little bit more affordable if you start getting like groups of like 20 people together and go buy this 20-unit apartment building and everybody rents. But yeah, it's kind of inflexible. It's just not practical. Right. So for, an active real estate investor, like you're never going to sit there and say, oh yeah, well, I'm going to commit like 80% of my units being affordable. It's just, unless you've owned the building for decades, that's just not going to be a reasonable play when it comes to being able to, invest in real estate using some significant amount of leverage.
Right. So for right now, there's nothing official that is changing. It's just
Nothing official, just lots of chatter.
lots of chatter. Okay.
Lots of chatter, lots of lender comments. But
Nothing official yet. Okay. So, I mean, thanks for going through the MLI. I don't think we've actually ever gone through it in that much detail so far yet. So it's definitely a good exercise.
yeah. So I guess I'll summarize the exit point, which is, I guess, the one thing we didn't really touch on, which is that the conventional program allows up to 85% loan value. This theoretically allows 95, but net operating income has to be there. Conventional program requires 40-year amortization. This allows you to go up to 50. Regular program is 1.2 to 1.3 debt cover. This is only 1.1, so like potentially a higher advance rate. And then the final thing, which is really awesome, is the conventional program, the insurance premiums can be like 4.5, 5, up to 5.25. The insurance premium on this at 95% loan value is only 1%. So your insurance premium could be cut by as much as like 80+%. So it makes the CMHC funding in general a lot more affordable, with better terms, with a better advance rate, and even from some lenders, more attractive interest rate.
So if somebody does want to go through that route though, like, do they need to let somebody know beforehand so that there's a whole process?
Yeah, it depends on which channel they're looking to go through, right? So like when it comes to like affordability, it's not really a big deal. Like when we do the submission, if you say, okay, well, I want to deem like these units affordable, we're going to use that affordability to get our points. Like we just simply put that in the submission, not a big deal. Where I think we really kind of separate ourselves from a lot of the other brokers out there is like having the understanding of the energy efficiency side, right? So it's having investors that are buying the building. They're not going to CMHC yet. We're working with a project lender, credit unions, what have you, to do the acquisition, the construction. But at the time that we're doing that, we're going in, we're getting our energy audits, right? We're sending the auditors through saying, hey, let's do the building baseline. Here's the renovation scope. If we complete this scope, how much more energy efficient are we? How many points did that get us, right? And then they can say, well, that only brings it to 36. Okay, well, what else can we add to this to bring it to 40? Or this brings you to 50. You don't have to go that far. You can scale it back a little bit. So as we go through that rehabilitation construction process, way before we're going to CMHC, we're actually working with the auditors to make sure that when it's ready for CMHC, ducks are in line, certificates are signed off, and it's just simply like a 2-pager that goes over to CMHC to say, hey, the energy auditors have signed off that we met this metric.
Yeah. And I think that's important. Like we hired Evna Engineering as an example to help us go through it and just make sure that like on the exit, we haven't missed any holes along the way or steps along the way. And I think it's just a lot easier to work with a company that's done it before, right? And they've taken other, buildings through that program because it's still very new and not a lot of people know how to do it successfully yet. Like what is it, a 8-month program so far, the MLI Select?
Yeah, we just said 12 months on it. Crazy, but
yeah,
it wouldn't have been that long. But yeah, it's just been out since last March. So
it's still so new.
Yeah, exactly.
Still so new. So The other thing too, I think you gotta, prep your clients to be able to like exit and or bridge with a CMHC approved lender. Can you talk about that? Like, let's just say you've got a building that's decrepit. It's the stuff we love, and then there is a process before you go to CMHC that you've got to consider.
For sure. Yeah. I mean, so CMHC is really only used kind of at a point of stabilization, right? At the long-term debt solution, there are some nuances to how you could refinance midterm with a carry pass model and stuff, but it's kind of messy and I won't really get into that. It doesn't make sense for smaller projects anyways. So usually what happens is you're acquiring something, you're using some sort of lender that's going to understand that the debt servicing in that building is not what you want it to be. Rent's probably too low, perhaps it's vacant, and it has to go through some sort of transformation, right? So for us, a lot of people out there do it with private, which is totally fine, right? It's very easy, just true equity lending. I find that can be a bit expensive, number one. Number two, we have had a couple issues with, and this happens very rarely, but with CMHC is usually pretty loose about not using an approved lender. As long as you can kind of show the intent, it was like, we didn't just own this and then leverage it and then come have you take it out. Like, we actually used the lender to buy it and acquire the property. But I've actually had situations last year where CMHC, we could show the whole paper trail the private's used for the acquisition, like really clean cut in, and CMHC disallowed it as an approved lender. So because it wasn't an approved lender, they'd have to recognize that most of the money that they were financing was going to a debt takeout.
Mhm.
And what that meant was it actually had to go down and approved use. So let's say the mortgage was but let's just say it was for $1 million and the private was 800,000. If they had been recognized, CMHC would have said, okay, we're going to take 800 grand, pay off the debt. We're going to take 200 grand. You have to now use that for multifamily investment. In this case, they said, you have to take the whole million. And in the next couple of years, use that for multifamily investment. We're not going to treat the private as a lender. So I prefer staying with project lenders. Got lots of great, I'd kind of call them akin to like the B lenders of the commercial space. So they understand the projects, they'll do interest only facilities for 12 or 18 months, usually some sort of 75% acquisition facility, maybe anywhere from 50 to, let's see, as high as 100%, depending on how juicy the project is, of a construction facility. So they're coming in, they're basically your financing partner for the project. And so they're going to help you acquire and renovate it. And then they're going to later be taken out by CMAs. And so that's usually the type of strategy that we employ on these kind of rehab projects where, to your point, we have this old dump that needs to be completely overhauled. It's those type of lenders that are really the ones that kind of facilitate the ability to get that done at a reasonable loan value, right? And without paying exorbitant interest and fees.
Mm-hmm. Okay. All right, cool. I can't believe we spent almost half an hour talking about CMHC MLI, but you know what? We dug really, really deep into it. So here's what we're going to do. The next part is the lightning round, but since you've already been on the show a couple times, I'm just going to make up the questions as we go, and I'll keep them related to financing. Ready? All right, let's play. Or real estate, and just because you're an investor too. So, question number 1, what is your current least favorite real estate investing strategy for 2023 onwards?
You're going to hate me. Airbnb.
Okay. All right. Why?
Airbnb. For us, we're seeing a lot of regulations pop up in a lot of cities that can be really, it can take a project that looks great on paper, and 12 months later, city comes in and overhauls, and it can just obliterate your opportunity. And the other thing that I find it really hard, maybe it's a bias because I'm on the mortgage side, those portfolios are really hard to scale because the lenders don't like them. So it's really hard for people to come in and say, hey, I want like 3 or 5 cottages and we're going to Airbnb it. Really, really challenging as a broker to find good rates, good loan to value solutions. A lot of people scale those portfolios.
Okay. All right, cool. Number 2, what is your favorite strategy for investing in 2023?
Personally, building flipping. So we do a lot of building repositioning where we're buying an asset. We're not taking it right to the end of the project, but we're kind of prepping it. Maybe that's vacating it. Maybe it's getting permits. Maybe it's adjusting zoning. Maybe it's getting contractor quotes, energy audits. And it's basically, we're taking it to the point of being able to sell a project in a box for another investor to go run it across the finish line, and we jump on the next deal.
Okay. All right. Awesome. Question number 3. There's lots of talks about investors selling, taking the money, getting out of the country, investing elsewhere. What are your thoughts on out of country investing?
Yeah, I think there's a lot of opportunities out there. I think that's one of my big focuses for 2023 is to learn more. I have a lot of people in my world that are moving towards investments in like the US, Caribbean, Central America. I had to be pretty honest with myself this year and realize that I didn't spend enough time over the last couple of years kind of educating myself about the opportunity there. So I think that's a big focus for me, is just to really understand what's going on in some of these other areas. And figure out what other people are doing, but I can certainly understand the sentiment with where prices and rates have gone here.
Okay. All right. Number 4, are you seeing many defaults, or are you still seeing that people are holding on and continuing to pay? Like what's the fear in the market, and what's the chaos that you're seeing in the back end that you're able to share?
Yeah, that's an awesome question. So what I would say is I'm seeing more than it's not necessarily more than I expected to see, but it's certainly more than we saw in 2021. What I would say from our client database is that it really comes down to the type of investor and the strategy that they employed. So I've seen a lot of people who got into, let's say, in over their heads, really, really high loan to value, really, really high cost privates, no super clear exit strategy, or maybe just one exit strategy, like, hey, we're going to go in and we're going to flip this, right? And then if you can't flip it, like, then what happens, right? Because they don't have the income to qualify for something else, found enough equity in the property. I think the investors who are really prudent, who kind of went out with focused approaches, understood multiple exits, had reasonable lending terms, I haven't had a single one of them default. All of the defaults I've seen were people that are levered at 80, 85, 90, 95% loan to value with 10 to 15 to 20% interest rates. That's where I'm seeing people really get stretched. Private lenders, there's a lot of them that investor money got a little scared. So we saw a lot of lenders that were traditionally would have no problem doing renewals, not wanting to renew. Right now, they initially issued the mortgage at 70%. Now it's at 90% loan to value. It's up for renewal. They're saying, hey, you know what? Sorry, we want out, right? And so I'm seeing a lot of technical defaults. And so these are defaults where it's not necessarily that the borrower can't make the monthly obligation, but it's that we've come to the end of the term. The lender said, hey, we're not interested in renewing, but because of where the values have gone, there's not another lender to come in and take their place. And so it creates a very, very tricky situation for the borrower, because even if they can afford the payments, they're kind of SOL. And so, yeah, that's more of the rise I've seen, is that type of situation.
Interesting. All right. Last question. Question number 5. As a real estate investor right now, where are you looking and where are you finding the deals? Are they on market or off market?
So the last 2 that we got were both on market. We got a couple off markets in the pipeline. I still think it's a really good mix. I still think there's lots of on market opportunity. I know not everybody shares that sentiment. The one thing I'll say about on market, I mean, everybody knows there's lots of awesome off market deals. One thing I will say about on market is a lot of our clients have been on things that we were able to take a unique look at. We saw something, we saw an ability, we saw highest and best use in that property that not everybody else was seeing. And in a lot of cases, their properties have been sitting for months and months and months. The price points were very negotiable. We were 10, 15, 20, 30% off the list price. And we were just able to kind of create a vision for it that other people weren't looking at. And so that's really been our big success with the on-market stuff lately.
All right. Very cool. David G., thanks for being on the show. Where can my listeners reach out and find out more?
Yeah. So feel free to email david@visionmortgagegroup.ca. We also just launched our social media this year, which is something we did not have last time I was on this. So we are on Instagram, we're at Ask Vision Mortgages. And always happy for people to call and text 289-981-2802.
Amazing. Thank you so much for being on the show. Great insights. And thanks for dissecting the CMHC MLI program with us.
Awesome. Thanks so much for having me, Sarah. Till next time.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?